Would you invest your money in the stock market if I told you the expected rate of return for the next 10 years was anywhere between +2 and -2 per year? In today's video, we are going to talk about some history and go back 27 years and look, and based on the current price that investors are paying for the S&P 500 today, what has been the historical rate of return? So let's dig in. This chart here, going from top to bottom, gives you the annual rate of return in the S&P 500 for 10 years, and going left to right is the price that you pay. So if you go all the way to the bottom left, you see that 8 times. That means people are willing to pay $8 for every dollar in earnings, all the way over to 26 times. People are willing to pay $26 for every dollar in earnings. So over on the left side is cheap, over on the right becomes more expensive. And if you look at the annual rate of return, right in the middle is 0. You go down, obviously that's negative. You go up, and that is positive. And what do we see when we start looking and seeing, okay, is there any kind of a pattern? Well, what happens is when we look and we say, what is the price that you've paid over the last 27 years, and what returns have you gotten over the next 10 years, here's where the dots land. And as you can see, this is a series of downward sloping dots. What story does this tell us? This tells us that as you move to the left, as in you buy the S&P 500 for a lower priced earnings ratio, or you pay less, you get a higher rate of return over the following 10 years. And so we have 27 years worth of monthly observations, or said another way, 324 dots represent 324 monthly observations that show us that the more that you pay, the lower your 10-year average rate of return has been. I say, okay, that seems to make sense. You pay more for an asset, potentially you have a lower rate of return. Well, where are we today in the S&P 500? Currently, this is the level that we are at, so kind of in the low 20s. Now, if you were to match that up with the dots, where does that put us for the expected rate of return? Or at least over the last 27 years, where have we landed? Well, over the last 27 years, if you were to pay for the current multiples like we've seen in the S&P 500, under every observation, you would have returned somewhere between +2 and -2 annual rate of return for 10 years. Now, that is not great, and most likely as I'm telling you these numbers and you think about your own plan, anywhere between +2 or -2 is most likely not going to help you achieve your goals, whatever they may be. And so, how should you look at this? Should you say, well, Kyle, I guess this just means I should not invest in the stock market? Well, no, because this is just the S&P 500, which is, as we've talked about in prior videos, heavily weighted towards a small number of very expensive stocks. It's just the way the index is built. And so the good news is, once you look outside of these large expensive stocks, the rest of the world, and many times the rest of the country, becomes much more reasonably priced. And this chart here, where we look at over to the left, you go up, as in you pay less and you get a higher expected rate of return. This doesn't just apply in the S&P 500. You can look at this across the world and across the United States when you're investing in assets. If you pay less, you get a higher expected rate of return. If you pay more, you get a lower expected rate of return. This is consistent with just the methodology of investing. You're buying future cash flows. If you pay more for cash flows, you get a lower expected rate of return. That's okay, it's just math. And so when we're looking at this chart, it's important to, when you think about the S&P 500, which is what many people watch, don't look backwards at the last 10 years and say, wow, these returns look great, this is where I should be allocating. Look forward and say, based on its current valuations and the current price, what can I expect moving forward can help you build out your financial plan. I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.